Okay, so let's start. We want to start a new topic now. So let me introduce the topic now. Let me introduce this topic. Now, as a company, there are various ways in which you as a company, you can settle your obligations. One way in which you can settle your obligation is by issuing your shares. You can issue shares as a payment for your obligation. For example, let us assume you are a company A and you wanted to buy a motor vehicle. So you went to General Motors and you saw a vehicle whose market value is 5 million. So you told General Motors you want to buy that motor vehicle. General Motors told you, instead of giving us cash, they told you as company A, instead of giving us cash, give us shares equivalent to the market value of that motor vehicle. So you are settling your obligation in that case by issuing your shares. So you bought that motor vehicle by issuing shares. So you paid by shares. So you will debit, you will debit motor vehicle account and you will credit your share capital account because you are settling your obligation by issue of shares. So this is one form of what we call a share-based payment. It's one form of a share-based payment where shares are used to settle obligations. That is one form. Let me introduce another one. Suppose, again, listen, you went to a company which is your supplier. You as company A, you went to your supplier and you purchased goods on credit for shillings 2 million. That is today. You must have debited purchases. You must have credited creditors. By how much? 2 million. When you bought the goods on credit. Now, listen. You also agreed with your creditor that you will pay him maybe 3 or 4 months from now. But, listen to this now. But, you will pay that amount in cash. Listen, you will pay that amount in cash. Listen carefully now. But, the amount to be paid in cash, you agreed. It will be computed based on the market value of a certain number of shares as at the date of payment. Let me assume that you agreed that when the time of payment will come, you will give cash, but that cash will be calculated based on the market value of 200,000 shares at the date of payment, based on the market value of the shares at the date of payment. So let us assume that the market price of the shares at the date of payment, it could be by the end of the year or whatever you are paying, maybe the market value of those shares is 9 shillings. So you as company A, you are paying your obligation, listen, in cash. But the amount to be paid in cash is being computed based on the market value of 200,000 shares as at the date of payment. If the date of payment, at the date of payment, the cash price or the market price is 9 shillings, then you will pay your creditor cash of how much? 1.8 million. It is obvious, listen, it is obvious that you as a company A, you are gaining. Your obligation when you undertook the transaction was 2 million. You agreed with your supplier, you will give him cash equivalent to the market value of 200,000 shares as at the date of payment. So it happened that at the date of payment, the market price was 9 shillings. So you gave cash equivalent to 1.8 million. Listen. So this is again another form of cash, another form of share-based payment. Sorry, it's another form of what we are calling share-based payments. Before I give the names, listen, you as a company, you are gaining. You are paying less for a higher obligation. That difference of 200, you will take it to the P&L account as a company. What if at the time of payment, the market price was 11 shillings? What if at the time of payment, the market price was 11? On the day you bought the goods on credit, the market price of the goods was 2 million. So you debited purchases and you credited creditors by 2 million. But you agreed with your supplier at the date of payment, you will give him cash equivalent to the market value of 200,000 shares at the date of payment. So if at the date of payment, the market price is 11 and the number of shares you agreed to use are 200,000, then it means you're going to pay cash worth 2.2 million. That is what you will pay. You will debit your creditor by 2.2 million and you will credit cash. So this time, as a company A, you are losing. You are paying more for a less liability. That difference, take it to the P&L account. That is 200,000. Now listen. So having introduced those two items or those two transactions, listen now, we normally have different types of what we call share-based payments, types of share-based payments. So far, I've discussed two of them. One of them, which was my first one, listen, one of them, which was my first one, is what we normally call the equity settled. We call it equity settled share-based payment. Where, listen, I settled my obligation in terms of shares. You settle your obligation by issue of shares. When you bought that motor vehicle for 2 million or 5 million, you debited motor vehicle and you credited share capital as a form of payment. That is what we call equity settled type of share-based payment. Number two, the second transaction is what we call cash settled transaction. We call it cash settled share-based payment. Cash settled. Listen, whereby as a company, you're settling your obligation by giving cash. You settle your obligation in cash. Listen, you settle your obligation in cash, but the amount to be paid in cash is computed based on the market value of a certain number of shares, based on the market value of a certain number of shares as at the date of payment. As at the date of payment. That's the second type of what we call share-based payments. Number one is equity settled. Number two is cash settled. Number three, the third type of share-based transaction is what we call choice of equity settled, choice of equity settled or cash settled, whereby an entity may decide, an entity within the contract may decide how the obligation should be settled. either party have a right to choose how that obligation should be settled, either in cash or in terms of equity shares. Okay, so those are the three types of share-based payments. Sometimes you are asked to talk about the types of share-based payments, and I've told you number one is equity settled, where a company would settle its obligation by issue of what? Shares. Number two, cash settled, where a company would settle its obligation in cash, but the amount to be paid in cash is computed based on the market value of a certain number of shares as at, listen, as at the date of payment, as at the date of payment, not as the date of the purchase, as at the date of payment. Good. The third type of share-based transaction is what we are calling choice of equity or cash settled. So either party or either entity, an entity has a choice of how the obligation should be settled. Good. So let me continue from there now. Listen, before we continue, there are some one or two students in the group who is new, and therefore there are also some who have attended for free today. I've admitted them for free. So listen to those new students. Please subscribe. If you have not subscribed, please subscribe to my YouTube channel if you have not subscribed. This could also apply to my old students. If you are watching and you have not subscribed to my YouTube channel, please subscribe. On the page you are watching this video from, there is always a subscription button down there. Click on that button and you will be able to subscribe. You can also click the notification bell. So if you have not subscribed, please subscribe. Okay. The other thing is, for those who have not joined classes officially online, those who have not joined and you would wish to join our online classes, we have online classes for advanced financial reporting. That is for the advanced level. We also have for advanced financial reporting. If you have friends who are doing financial reporting of the intermediate, and if you have friends who are doing financial accounting of the foundation level, we also have online classes for them. Again, if you have any interest, you are in this class and you have an interest in the advanced financial reporting, you can call me on 0722 65 8875. For advanced financial reporting, we always have either early morning classes or evening classes. We either have early morning or evening classes. Okay, good. Alternatively, listen, if you're not able to attend the live classes, I'm talking to the new students, or yes, I'm talking to you now. If you're not able to attend the live classes, then you can also buy what we call pre-recorded videos. You can buy what we call pre-recorded videos, where you get the videos for the whole syllabus at once and you listen to them at your own free time. Good. I think that's all I wanted to say, especially for those who have joined us today and for the students who are joining us. Okay, please subscribe to my YouTube channel if you have not subscribed. I've said even to the old students, you are a student and you have not subscribed, please subscribe. Click that subscription button even now as you are watching. Then I've said for those who want to join our online classes, either for advanced financial reporting, the one we are doing now, or for financial reporting for your friends, or financial accounting of the foundation level, please call me on 0722 65 8875. Then I've said, if you're not able to attend live classes, you can buy what we call pre-recorded videos. Good. I think that's all. So let me continue now. Let me continue from there now. So we have now discussed the types of share-based transactions. before we go further, maybe we can put down something now on what we have already said. So have a subtopic, the topic, put down the topic, put down the topic. Our topic is called share-based payments. Share-based payments, and it's covered under IFRS number 2. It's covered under IFRS number 2. Once you put down the main topic, below that, andika another subtopic. Below that, andika another subtopic. Below that, andika another subtopic. Types of share-based payments. Types of share-based payments. Types of share-based payments. Types of share-based payments. Number 1. Types of share-based payments. Number 1. Equity settled. Number 1. Equity settled. Equity settled. Then you say this, put a dash. Equity settled. This is where equity settled, put a dash. This is where a company would settle its obligation. A company would settle its obligation by issue of shares. This is where a company would settle its obligation by issue of shares. Number 2, cash settled. Cash settled. Number 2, cash settled. Then you put a dash. This is where a company would settle its obligation. This is where a company would settle its obligation in cash. They will settle their obligation in cash, comma, but the amount to be paid in cash, will be computed, based on the market value, of a certain number of shares. Based on the market value of a certain number of shares as at the date of payment. Based on the market value of a certain number of shares as at the date of payment. As at the date of payment. Good. Number 3. Choice of equity settled or cash settled. Choice of equity settled or cash settled. Choice of equity settled or cash settled. Then you put a dash. Where an entity has a choice. Where an entity has a choice of cash. Where an entity has a choice of cash or shares. Where an entity has a choice of cash or shares paid. Where an entity has a choice of cash or shares paid in settling the obligation. In settling the obligation. In settling the obligation. In settling the obligation. Okay, now let me continue now. That is what we have discussed so far. So I want you to listen now. The other question we want to answer now is this. Listen, if you have an equity settled transaction, how is that transaction measured? How is a cash transaction or cash settled transaction measured? Get the point now? Let me take you back. When I was buying this motor vehicle, today I went to General Motor, I saw a motor vehicle whose market value was 5 million. We agreed I'm going to give them my shares worth 5 million also. So I gave them the 5 million worth of my shares and they gave me the motor vehicle. Listen. So you are settling that obligation. Listen carefully now. You are settling that obligation based on the market value. Based on the market value at which date? At the date we signed an agreement of buying that motor vehicle. That date, the market value of the shares at that date, we normally say those shares are valued at the market value at the grant date. We call it the grant date. So for equity settled, listen, for equity settled, the shares are normally valued at the market value of those shares at the grant date, the day we bought that motor vehicle. Okay, good. So we normally value, listen, we normally value equity settled based on the market value of the shares at the grant date. At the grant dates. So, good. Now, if you look at the second one, today I purchased goods on credit for 2 million. That was the market value on the day I was purchasing the goods. So I debited purchases, I credited creditors by 2 million. We agreed, listen, we agreed that I'm going to settle this obligation 5 months or 1 year from now, whichever the date. When the date of payment came, I was supposed to give them, or I'm supposed to give them cash, which is based on, listen to this now, which is based on the market value of a certain number of shares as at, listen, as at the date of payment. The first time we saw the date of payment, the market value was 9 shillings per share. So I gave them cash amounting to 1.8 million. Listen to this now. So we are settling that obligation based on the market value of the shares as at when? As at the reporting date. When we are paying the cash, what is the market value of those shares? That is the reporting date. If you are paying after 1 year, what is that market value at that date? So if it's by the end of the year, what's the market value of the shares as at the end of the year? So we are saying, listen to this, that when you are dealing with a cash settled transaction, then that should be settled using the market value of the shares, using the market value of the shares as at the reporting date. As at the reporting date. Very important to know which market value am I using. Is it the market value of the shares as at the grant date, or is it the market value of the shares as at the reporting date? I've told you, if it is equity settled, use the market value of the shares at the grant date. Like when you bought that motor vehicle and you are giving shares as a payment immediately. What is the market value of the shares as at that date? Okay, good. 2, cash settled. It is measured based on the market value, though you are giving cash, but based on the market value of the shares at each reporting date. At each reporting date. Good. Of course, the last one, it depends. Now, so let's put down that information. So have another small subheading. Measurement as a subheading. Have it. Measurement of equity settled. Measurement of equity settled transactions. Measurement of equity settled transactions. As a subheading, measurement of equity settled transactions. Then you say this below that. Then you say this, measurement of equity settled transaction. And you say this should be measured. This should be measured based on the fair value, which is the same as market value, based on the fair value of the goods, at the grant date. Based on the fair value of the goods, you are giving shares equivalent to the market value of the goods, based on the fair value of the goods at the grant date. Underline that word, grant date. That is important, because questions now are based on that. When you are given questions, you will have to identify whether you are dealing with an equity settled transaction or you are dealing with a cash settled transaction. That is what we shall see later. Okay? But for now, just know that if it's an equity settled, you compute it based on the fair value at the grant date. Okay? Another subheading, measurement. Another subheading, measurement of cash settled. Measurement of cash settled transactions. As a subheading, measurement of cash settled transaction. Measurement of cash settled transaction. Measurement of cash settled transaction. Then you say this. In this case, the obligation should be measured. The obligation should be measured based on the fair value, at each reporting date. Underline that again, it's important. At each reporting date. Another paragraph under that. Any change in fair value should be transferred. Any change in fair value should be transferred to the profit and loss. Any change in fair value should be transferred to the profit and loss. You remember one time we made a gain of 200, another time we made a loss. When we paid 1.8 in cash to the creditors, we made a gain. That gain is what I'm taking to the P&L. Another time we made a loss, that's what goes to the P&L. Good. So that is all about the types of, listen, that's all about the types of share-based payments and how they should be measured. Are you there now? We continue. I hope you're okay now. There are two types, cash settled, equity settled. The third one, choice of equity or cash settled, and how each of them is remeasured by the end of the year, by the time of the transaction. You're saying cash settled, measure it based on the fair value at the reporting date. Equity settled, measure it at the fair value at the grant date. Good. Now, let me develop the topic We want to move on now to something else. We want to move on now to something else that we call share. We call it share. Employees, let me put it that way. Employees share options. Employees share options. Let me introduce it. Of course, share options is not a new term to you. Share options is not a new term to you. So I want you to listen carefully, because there are terms we shall discuss here and concepts that I want you to understand, because we shall use them in the computations. So I want you to listen carefully first. I'm going to go through first. Before we put down anything, I'm going to go through first to give you the concepts behind share options and how you as a company, whenever you have an employee share option, how you should account for that share options. Okay. Now, let me assume that as a company, for now, I'm assuming, listen, that you have 1,000 employees. You are telling them that if these employees remain in service for 3 years, then by the end of the 3rd year, you will give them the privilege of buying shares at a price below the market price. That is what we call a share option. You agree with the employees, for example, that if they remain in service, we are assuming for 3 years, then at the end of the 3rd year, whoever will be there at the end of the 3rd year will be given the privilege of buying. Let us assume they will be given a privilege of buying 10,000 shares. So let me also assume that today it's 1st January 2018 for purpose of illustration. So when will these employees become eligible to exercise that right? They will become eligible at the end of the 3rd year, which will be 2018, 2019, and 2020. So by 31st December 2020, that's when the employees will become eligible to exercise that right. Now listen. The day we are agreeing with the employees, that is 1st January 2020, that date, we call it, or the day we signed an agreement, we normally call it the grant date. We normally call it the grant date. I want you to listen to some of the terms. We call it the grant date. The day they will be qualifying to exercise the right, the day they will qualify to exercise the right and buy the shares, which is 31st of December 2020, that date, we call it the vesting date. We call it the vesting date. Okay? Listen again. The period they have to wait for the criteria to be met, the period of 3 years or 5 years, whichever it is, the period they have to wait for the condition they have been given to be satisfied, that period they have to wait, that period, we normally call it the vesting period. We normally call it the vesting period. We call it the vesting period. Now, the condition they have been given to meet before they qualify to exercise the right, whichever condition it is, that condition is called the vesting condition. We call it the vesting condition. So these are some of the terms. Sometimes you may be asked in theory questions to explain what is a grant date, what's a vesting date, what's a vesting period, what's a vesting conditions. Okay, so we have said vesting date is the date the employees become entitled to exercise that right and buy the shares, for example. Okay, vesting period, we have said it is that period they have to wait for them or for the criteria they have been given to be satisfied. period they have been given for the condition to be satisfied, that period they have to wait is called the vesting period. Now listen, the condition they have been given to meet in order for them to qualify to exercise that right, that condition is what we call the vesting condition. Listen, there are various conditions that a company can give for their employees. I've just given one example. Listen, I've just given one example of the vesting condition. Meaning, or that example is where the employees are required to remain in service for at least 3 years, or remain in service for 3 years. That kind of a condition, we normally call it the service condition. We normally call it the service condition, where the employees are required to remain in service for a particular number of years for them to qualify to exercise that right. We have it as a service condition. Listen, there are other companies that give other types of conditions. For example, employees could be told, especially senior managers, they may be told, if the market price of our company shares increases to 50, maybe it's currently 30. If the market price of our company shares increases to 50, then you will be given the privilege of buying 10,000 shares, blah, 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 whatever it is. So that kind of a condition is not a service condition. It's a performance condition. Or the employees could have been told, especially again the senior managers, if our profits exceed 2 billion shillings this year, we as a company, we shall give you the privilege of buying 10,000 shares. So that is another condition. It is still on performance. So the second condition is what we call performance conditions. Performance condition. Now, under performance condition, listen to this. Under performance condition, there is what we call market-based conditions. Market-based. Market-based means that you as managers, you are told, if the market price of the company shares hit 5 shillings or 50 shillings, the market price of the company shares hit 50 shillings, then we shall give you the privilege to buy the shares. That's a performance condition, but it's based on the market, based on the market. Then we have other conditions, we call them non-market based conditions, whereby, for example, listen, you are told, if the profits of our company exceed 2 billion, we as a company, we shall give you, the managers, the privilege to buy 10,000 shares. So that's a target you have been given to achieve, but it's an internal target. Make our profits exceed this much. It's not based on the outside market, no. Or maybe told, please ensure that our company's earnings per share is 5 shillings. Maybe it's currently 3. So you are told as managers, if the earnings per share of our company becomes 5 shillings per share, we shall give you the privilege to buy those shares. So that's a performance condition, but it's non-based, market-based, non-market-based condition, non-market-based conditions. Okay? So we are saying, when it comes to vesting conditions, we either have service condition, meaning you have to remain in service for a certain period of time, or you can be given another type of condition, that is what we call performance condition. And under performance condition, I've said, you are either having market-based condition or non-market-based. Market-based is an example we have given when the market price of a company shares hit this much. You as a company management, you are given a target to increase your market share price to this much. That's market-based. Non-market-based is, for example, where you are given a sales target. It could be a sales target, it could be a profit target, or it could be an earnings per share target. Good. Now, before we put down anything, listen, this kind of a share-based option that you as an employee, you are going into an agreement with your employees. Listen, we normally consider share options, or you as a company, you should consider this share option as part of, you should consider it as part of the remuneration package of your employees. You are required, whenever you have a share option or a stock option, you are normally required to account for it as part of the remuneration package of the employees. Meaning that you as a company, you are required to recognize a cost every year. Recognize a cost. For those 3 years, recognize a cost, because you are taking this option as part of the remuneration package. So what I want to demonstrate now, before we put down the summary notes, is how much will you recognize as a company? How much will you recognize as an expense in the year 2018? How much will you recognize as an expense in the year 2019? How much are you going to recognize as an expense in the year 2020? Those are the 3 years I want to discuss now. Okay? So let me demonstrate how much. And I want to assume you are giving the employees the privilege, listen to this now, you are giving the employees the privilege to buy 10,000 shares. That's what I assumed. 10,000 shares. I also told you, you have 1,000 employees currently. You told them the condition was this: if they remain in service for 3 years, at the end of the 3rd year, you will give them the privilege to buy 10,000 shares each. Now listen. So we need to know how much shall we recognize as the expense for year 1, 2018. I want you to follow now. You have 1,000 employees. Listen, you will have to ask yourself as a company, how many employees are we expecting will be there at the end of the 3rd year? How many employees are we expecting will be there at the end of the 3rd year for them to exercise their right and buy the shares? In other words, you need to estimate the number of employees out of their 1,000. How many are we estimating will be there at the end of the 3rd year? So to compute the cost of year 1, I have to find out the best available estimate of the employees that are expected to vest at the end of the 3rd year. Listen, a question might tell you, listen carefully now, a question might tell you that in the 1st year, 2018, some 20 employees left. Some 20 employees left. So we already know those ones left. They are not going to be there. Those ones have already left. Listen. Then the question also tells you, we also expect that another 30, listen, another 30 will leave in each of the next 2 years. We are at the end of year 1. In the next 2 years, that is 2019 and 2020, we expect another 30 employees will leave in each of those 2 years. So if we expect another 30 to leave in each, then means therefore, by the end of the 3rd year, another 60 are expected to leave. Hope you are following. So we expect therefore that by the end of the 3rd year, we shall have how many employees to qualify? It will be 1,000 minus 20 minus 60. That gives me, that is 9 what? 920. Those 920 employees, these are expected to leave. Those 920 employees, listen, are going to buy 10,000 shares. Listen to this now. Because they are going to buy shares, not to be giving them cash, we are dealing with equity settled. Listen, we are dealing with equity settled kind of a transaction where the employees will be given shares. And I told you, listen, I told you, if it is an equity settled transaction, then it should be measured at the fair value of the option at the grant date, So you will have to find out from the question, as at 1st of January 2018, what was the fair value, what was the market value of the option? What was the market value of each option? Listen, the question might tell you the market value of the option on 1st January 2018 was 15 shillings on 1st January 2018. So you are giving, or you will have 920 employees are expected to be there. They will buy 10,000 shares each at a price of 15. Listen carefully. That total that you're going to get, that total is what you're going to spread over 3 years. Whatever total you are having is what you're going to spread for those 3 years. So to get the amount you're going to charge in year 1, 2019, remember now you have 3 portions out of the vesting period. So to get the cost for the first portion, you would multiply this by 1 over 3. You multiply that by 1 over 3. So you are getting a third of the portion. If there are 4 portions, you have to multiply by 1 over 4, depending on the question. Good. So let me calculate now. To see how much of the total. We are trying to spread the cost. First, how much is the cost? Let me calculate how much is the cost in total. We had 920 employees expecting to be there. That is 1,000 minus 20 minus 60. There are 920. Each of them will buy 10,000 shares at a price of 15. That will come to something like a total cost of 138 million. Spread that 138 million over the vesting period. Because we are computing the cost of year 1, I multiply this by 1 over 3, which is the same as just dividing by 3. That comes to 46. Now listen, that 46, you will debit. I want you to listen carefully. You will debit P&L account as an expense, and you will credit a reserve account. You will credit a reserve account. You have not given them shares by end of year 1. You will give them the shares in the 3rd year. But you are required to recognize a cost of 46 million in year 1, and at the same time create a reserve which will be converted into shares at the end of the 3rd year. So it means this 46 in year 1 will be debited in the P&L account. At the same time, you create a reserve. We call that reserve an equity option. We call it an equity option. And at the same time, that same 46 by end of year 1 will be the expense for that year. So you will debit P&L account with that expense of 46 million, and you will credit equity option or that equity reserve. That is for year 1. Let me do year 2, and I want you to watch carefully now for year 2 as the argument go by. We come to 2019. We had 1,000 employees. I have told you, listen, what is the best available estimate of the employees that we expect will be there by the end of the third year. Remember, they will only exercise at the end of the third year. Listen. So it means, therefore, every year, listen carefully, as a company, you are required to do a re-estimate. You re-estimate at the end of each year. So year one, we already know 20 employees left. 20 we know they left in year one. The question might tell you, listen to this now, the question might tell you another 40 left in year two. Another how many? 40 left in year two. So these ones left in year one, these ones left in year two. Now listen, then we were told at the start of the question, listen, we were told at the start of the question, when we were doing year one, and 30 employees are expected to leave. Listen, and 30 employees are expected to leave in each of the following 2 years. That's what we were told for data of year one. So now that we are in the year two, we ask ourselves, we are trying to project those who will be there by the end of the following year, third year. So it is obvious when we are doing data of year two, we come and say we expect another 30 to leave. By end of year three, we'll have left. We are in the third year now. Good. Then again, listen, multiply that by 10,000. Multiply that by the fair value at the grant date. We are dealing with an equity settled transaction. So you come and multiply that by 15. Listen to this now. Again now, we are in the second portion of the third portion of the three portions. So how much should we recognize as the reserve in year two, and how much should we recognize as an expense of year two? So you multiply this by 2 over 3. That's what we are trying to do. We are still trying to spread the cost, okay, over the service period, the vesting period. So let me multiply. We have 1,000 employees, 20 left in the first year, another 40 left in the second year. So those ones are automatically known. We expect another 30 will leave next year. Okay. So we expect that how many will be there by the end of year 3? This will be 1,000 minus 20 minus 40 minus 30. So we expect 910. Listen, 910 employees. Multiply that by 10,000 shares. Multiply that by the market price of the option, 15. Spread that cost over the vesting period. That is 2 over 3 now. We multiply that by 2 divided by 3. So that year, listen carefully, that year, our reserve will increase to 91 million. Listen, our reserve, not the expense for that year, our reserve. Remember, this is a cumulative cost. That is a cumulative cost. So that 91 becomes the cumulative reserve by end of year 1, by end of year 2, sorry. Listen. So if by end of year 1, the reserve was 46 million, and now it has increased to 91 by end of year 2, it means the second year alone, our reserve must have increased by how much? It is 91 minus 46. That gives me 45. So the expense for the second year will be recognized at 45. That's what we are getting as the expense for year 2. So in the second year, you will debit your P&L account by 45. You credit your reserve by 45 so that it increases now from 46 to 40 at 91. So you will increase your reserve by 45 in the second year. Okay, good. Now listen, final year, that is year 2020. Carefully listen. So this final year, we normally now don't need to estimate. We are at the end of the third year now. So we can actually tell which employees are there. Listen carefully. So in the third year, we don't have to use estimates. We use the actual number of employees that are there by the end of the third year. Because we are in that final year, we know who left in the first year, we know who left in the second year, and even in the third year now, we have everybody now who is still with the company. We can tell how many employees are within the company by the end of the third year. So in the third year, listen to this, you don't use the estimate number of employees. No, we use the actual. We use the actual number of employees. We use the actual number of employees. So we take the 1,000. Remember, in the first year, 20 left. In the second year, 40 left. Listen, you will be told in the third year, maybe another 10 left in the third year. 10 employees left. So again, those are the number of employees we expect that, not we expect, we know who are there by the end of the year and they will exercise. So multiply that by 1,000 or 10,000 shares times the market price of 15. We are doing for the third portion, so it will be times 3 over 3. So what does it come to? What does it come to? So let me compute the cost for the third year. Let me compute the cost for the third year. So I take 1,000 minus 20 who left in the first year, another 40 who left in the second year, and another 10 who left in the third year. So we are remaining with 930 who are going to exercise that right. Multiply that by 10,000, spread that again, or multiply by 15, sorry, multiply by 15. Just a minute, there's something I've done which is wrong. I can't tell where. Let me, 9, I'm repeating, 1,000. No, yeah, 1,000, sorry. 1,000 employees minus 20 minus 40 minus 10, that is 930. 930, multiply that by 10,000 shares. Multiply that by 15. Then times 3 over 3 is the same as 1. So this looks like 139.5. 139.5 million, listen, becomes the cumulative reserve by end of year 3. But what becomes the charge? The charge for year 3, it will be 139.5 minus the cumulative reserve by end of year 2, which was 91. So the increase in the reserve by end of year 2 is about 48.5. 48.5. Good. So I hope you are now getting how we normally compute the amount to be charged in the P&L account and the amount to go to the balance sheet as a reserve. I've told you, you use the estimate, the best available estimate in the first year, second year. Then in the final year, like in this illustration, final year, you don't use the estimate, use the actual number of employees. Good. Now, listen. So I hope that one you have understood. Listen carefully now. Suppose, same question in the following sitting. But the question tells you, listen carefully, the question tells you, these employees, if they remain in service for 3 years, they will be given cash. They will be given cash equivalent to the market value of a certain number of shares, the 10,000 blah 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 that we have talked about. Okay, listen carefully now. So this time, same number of employees, 10,000, whatever, 1,000, blah blah blah, 40 left, 60 left, everything the same. But Now they are going to be given cash if they remain in service. And the cash will be based on the market value of a certain number of shares, blah, blah, blah. Meaning now, listen, you are dealing with what we are calling a cash settled transaction, not equity settled transaction. You are not going to give cash as an employer. You're not going to give shares as an employer. You're going to give cash at the time of vesting. Okay, you're going to give cash. So we are dealing with a cash settled. Listen, I told you, for any cash settled transaction, that transaction should be measured. How? That transaction for a cash settled, I told you it should be measured how? I told you it should be measured at the fair value of the option at each reporting date. At the fair value of the option at each reporting date. So this time, you will not use the 15, 15, 15 I used. 15, 15, 15 was the market value of the option at the grant date. Get the point? At the grant date. But now we are dealing with a cash settled transaction. Saying for a cash settled transaction, we are saying use the market value of the option at each reporting date. So suppose question tells you by end of year 1, the fair value of the option was 15. That will remain that one. Sorry, that is 15. The second year, maybe you will be told market value of the option now was something like 18. We multiply that by 18. I hope you are following. Multiply that by 18. Okay. Third year, if the market price of the option by end of third year is maybe 21, then we are saying use 21 here. So you could be given a question in an exam and you imagine that it was a question that came last sitting. But there is a change of word. One question was saying they will be settled in shares. That's an equity settled. Another question told you it will be settled in cash. That's cash settled. Another key point. Listen to this now. If you are dealing with a cash settled transaction, listen to this point. If you are dealing with a cash settled transaction, then here you will not have what we are calling equity option or a reserve. You will not have a reserve. Instead, you will have a liability. Remember, you are not going to give shares 3 years from now. You are going to give cash. So you don't recognize a reserve. No. You recognize a liability. So where you are dealing with cash settled transaction, you don't recognize a reserve, you recognize an obligation. So like in the first year, assuming the figures remain the 46, you will debit P&L and credit a liability account of 46 million by end of year 1. Okay? Second year, let me assume the figures remain the same. Second year, you will debit P&L account by 45 and credit a liability by 45. Second year, the charge. That's what we are saying. Okay? So if it is, I hope you are following, if it is an equity settled, I told you, you create a reserve because you are going to give shares. So you create a reserve now. to be converted into shares when you settle that obligation by giving shares. So you create a reserve. But if you are going to pay cash, you don't create a reserve, you create a liability. You create a liability. The other important point I've told you is this. What is the fair value that you're going to use? If the question is for equity settled transaction, then I've told you use the fair value of the option at the grant date. If the question is a cash settled transaction, then use the fair value of the option at each reporting date. End of year 1, what is the fair value? End of year 2, what's the fair value? End of year 3, what is the fair value? Hope you are following now. Good. Now, I don't know now. I want to put down some notes now about what we have discussed. I want to put down some notes on what we have discussed so far. But before I give the notes, let me challenge you. I see whether you have understood. I want to challenge and ask you a question so that I see I am reframing. Listen, when it comes to these computation questions, the most critical thing to know or to understand is the language the examiner talks about. Like I told you, first year, 20 employees left. And it was expected that 30 employees, listen, will leave in each of the following 2 years, in each of the next 2 years. When I was doing year 1, I had 2 more years remaining, second and third. So we expect 30 will leave in the second year, another 30 will leave in the third year. So by the time I'm doing year 1, I expect another 60 to leave. When I'm doing year 2, now I'm expecting how many to leave in the next 1 year? 30. So I use 30, okay, in year 2 as expected to leave, okay. Then I've told you, if the data is for 3 years, for the first 2 years, you have to remember to use the estimate, best available estimate. Are you there? Good. Best available estimate of the number of employees that are expected to vest. Okay. Then I've told you in the final year, use the actual number of employees that are going to vest. That's another key important point. Now, let me use this language. Be ready to answer my question to now. The company again had 1,000 employees. Each of them will be given the privilege to buy 10,000 shares. If they remain in service for the next 3 years. So in the year 2018, the question tells you, this is 1,000 employees. The question tells you, listen, 2018. The question tells you 20 employees left. 20 employees left. Listen. Then it also tells you it is expected. Listen. It is expected that 60 of all the employees, 60 of all the employees will leave. It is expected that 60 of all the employees will leave in the next 2 years. 60 of all the employees will leave within the next or in the next 2 years. I hope you have understood that statement. Get it right before I ask you my question. So I've told you, listen, we had 1,000 employees. 20 left in the first year. Okay? And 60 of all the employees are expected to leave in the next 2 years. 60 of all the employees are expected to leave in the next 2 years. 20 left and 60 of all the employees are expected to leave in the next 2 years. So when you are doing your computation here, you will take 1,000 minus how much? Chart now and give me the answer. Chart now and give me the answer. When you are doing the computation for year 1, utasema 1,000 minus what? Somebody you chart and give me the answer. I'm waiting. Utasema 30 minus what? We are told, listen, we are told we had 1,000 employees, 20 left in year 1, and 60 of all the employees are expected to leave. 60 of all the employees are expected to leave. So somebody is saying it will be 1,000 minus 80. Another person, what's your opinion? One person is giving me 1,000 minus 80. I want to see an opinion for somebody else. Again, another person has given me 1,000 minus 80. I want you to understand that language. I want you to understand that language. I told you the only technical issue is the language. So 2 people are saying 1,000 minus 80, which is 20 and 60. Let me hear one more opinion. I'm not saying they are wrong, but I just want to hear one more opinion. One more opinion. Okay, now listen. Some people are not refusing to give me their opinion. Now listen. Listen carefully. The question is not, I'm repeating, the question is not saying 20 employees left. And the question is not saying, and a further 60 are expected to leave in the next 2 years. Okay, Maura has given me his. Maura is saying 60, 1,000 minus 60. Now listen. I'm saying the question does not say 20 left. It does not say and a further 60 are expected to leave in the next 2 years. Listen. The question does not say 20 left and an additional 60 are expected to leave in the next 2 years. No. So the question does not use the word and a further 60, or it does not say and an additional 60 of the employees are expected to leave. It says, get the point, it says 20 left and a total and 60, listen, and 60 of all the employees and 60 of all the employees are expected to leave in the next 2 years. So the question is, listen to this now, these 20, are they part of the 60? Yes or no? These 20, as per the question, are they part of the 60? Right there, yes or no. These 20, are they part of the 60? We are told 20 left. And 60 of all the employees, listen, 60 of all the employees are expected to leave. The question is, these 20, are they part of the 60? The question is either yes or no. The answer is yes. Listen, the answer is yes. They are part of the 60. So you cannot come and again say that it will be 1,000 minus 20 minus 60, like some of you have given me the answer that way. No. The trick here is the examiner wanted you to know that the 20 are already part of the 60. The question says 60 of all, we have 1,000 employees. 60 of all the employees are expected to leave in the next 2 years. So it means the 20 are already part of the 60. So you just come and minus 1,000 minus 60. Then you multiply that by 10,000 times 15 times 1 over 3. I hope you're getting. If the question had said, listen, if the question had said 1,000 employees left. No, we had 1,000 employees, 20 left. And it says, and a further 60 employees are expected to leave. Or it says an additional 60 employees are expected to leave. Then you come and minus 60. That is the language. So the trick here is that the examiner normally uses is the language. Understand the language. He will beat you on that language. How many are expected to leave? How many of the total? Blah, blah, blah. So I hope you are getting there. Are we together so far? Are we together so far? You chat and say yes. Are we together? Somebody like who? Maura, who had said a different answer. Are you okay now, Maura? Oh, Maura, you came up with 2 answers. Maura, you came up with 2 answers. So you are guessing, or you are sure of the first one or the second one? Maura, you wanted to rely on the first or the second? Because I can see Maura, you gave 2 answers. Okay, fine. I hope now you have understood. The tricky is the language. That the 20 or the second. Sawa. Okay, let me take it, Maura, that you meant the second. Sawa. So if you meant the second, then you are right. So you can see the true point that 60 of all the employees, meaning even the 20 who left are part of the 60. Even the 20 who left, they are part of the 60. Because we expect 60 of all the employees to leave. So if already 20 have left, then it's the same as saying, listen, it's the same as saying, we had 1,000, 20 left, because I saw somebody doing that way, and we expect another how many to leave? Another 40. Another 40. That's another way. That's another way. Because 20 have already left. So if 60 of all the employees are expected to leave and 20 have already left, then we are expecting another 40 to leave. Sawa. Okay, fine. So let's put down the summary notes now. Hoping you have understood. We put down the summary notes now on this subtopic. Put down the subtopic, employees share options. We have discussed several things, so we want to put down those terms. At the same time, yes, thank you. Now let's put down the subtopic. Call it employees share options. Employees share option. put down the subtopic, employees share option. Then you say this occurs where grants are given. Sorry, this occurs where the employees are given, the privilege. This occurs where the employees are given the privilege to buy shares, or get cash at the end of the vesting period. At the end of the vesting period, if certain conditions are met. Then you say this, another paragraph. Share options are considered as part of the remuneration package. For the employees. And therefore the company should recognize the cost of the service rendered, and therefore the company should recognize the cost of the service rendered, and therefore the company should recognize the cost of the service rendered during the vesting period. During the vesting period. Another paragraph. The total cost of the transaction should be spread. The total cost of the transaction should be spread over the vesting period. The total cost of the transaction should be spread over the vesting period. Another paragraph. The amount to be recognized as an expense. Should be based on the amount to be recognized as an expense should be based on the best available estimate. Of the employees. That are expected to vest. At the end of the vesting period. At the end of the vesting period. So go back to that statement and underline best available estimate. That's important. I've said the amount should be based on the best available estimate of the employees. So underline the keyword best available estimate. Okay, continue. Another paragraph. Another paragraph. This estimate should be revised. This estimate should be revised at the end of each year. This estimate should be revised at the end of each year. This estimate should be revised at the end of each year. This estimate should be revised at the end of each year. Another paragraph. Another paragraph. On the vesting date, on the vesting date, on the vesting date, the company should recognize, on the vesting date, the company should recognize the amount. The company should recognize the amount based on, company should recognize the amount based on the number, the actual, put it that way. Okay, put it this way, based on the number of options, based on the number of options that actually vested. Based on the number of options that actually vested. I've said on the vesting date, the company should recognize an amount based on the number of options that actually vested. So underline again, underline this term or these words, number of options that actually vested. Number of options that actually vested. That's what you're underlining there. In the year of vesting, you use the actual. Okay. Another paragraph. NB. 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 Then you say this, for equity settled, share options, for equity settled share options, for equity settled share options, comma, the amount to be recognized in the books for equity share, for equity settled share options, the amount to be recognized in the books, the amount to be recognized in the books should be based on, the fair value, should be based on the fair value of the option, should be based on the fair value of the option at the grant date, at the grant date. Should be based on the fair value of the option at the grant date. So underline the grant date, underline the word grant date. For equity settled, the key word there is grant date. Next paragraph. Next paragraph. For cash settled, for cash settled, for cash settled transaction, the amount to be recorded, in the books, for cash settled transaction, the amount to be recorded in the books should be based on, the fair value of the option, should be based on the fair value of the option at each reporting date. Should be based on the fair value of the option at each reporting date. Should be based on the fair value of the option at each reporting date. So underline the word each reporting date. Each reporting date. Good. So we are still discussing those terms. So have another subheading. Vesting conditions. Vesting conditions. We talked about several items there. Vesting conditions. We talked about several items there. Vesting conditions. So let's put down something there. Vesting conditions. Vesting condition. Then you say this. Vesting condition. Then you say this. This is the criteria. This is the criteria that has to be met. This is the criteria that has to be met in determining whether the employee receives cash, stock shares, receives cash or stock shares of the entity. This is the criteria that determines whether, or the criteria that has to be met in determining whether the employee receives cash, maybe it's a cash settle, or receives shares of the entity. Another paragraph. Vesting conditions may either be, number one, service condition. Vesting conditions may either be service condition. Number one, service conditions. Then you put a dash. Service conditions. You're saying vesting conditions may either be, number one, service condition. Put a dash. Which require that the employee, to complete a specified period of service. Which require that the employee to complete a specified period of service. Which require that the employees to complete a specified period of service. Number two, performance conditions. Performance condition. Performance conditions. Then you put a dash. Performance condition. Then you put a dash. Which require that specified, performance conditions, which requires that specified performance conditions are met before the employee becomes, which requires that specified performance conditions are met before the employee becomes entitled to the grant. Which require that specified performance conditions are met before the employee becomes entitled to the grant. Another paragraph. Performance conditions are of two types. Performance conditions are of two types. Performance conditions are of two types. Number A, market-based conditions. Number A, market-based conditions. Market-based conditions. Then you say this under that. Market-based conditions. Then you say this under that. Such as those. Market-based conditions, comma, such as those that relate to. Such as those that relate to the market price of the company shares. Such as those that relate to the market price of the company's shares. Such as those that relate to the market price of the company's shares. E.g., employees being required. E.g., employees being required to take the market price. E.g., employees being required to take the market price or the share price. That way, the employees being required to take the share price. Take the share price of the company. To take the share price of the company to a certain level. To a certain level. To take the share price of the company up to a certain level. Up to a certain level. Number B, non-market based. Non-market based. Non-market based conditions. Non-market based conditions. Non-market based conditions. Then you say this. Non-market based conditions, comma, such as those that relate to, the company's profit, such as those that relate to the company's profit or earnings per share. Such as those that relate to the company's profit or earnings per share. E.g., the employees being required. E.g., the employees being required to meet. The employees being required to meet a certain profit target. E.g., the employees being required to meet a certain profit target or EPS or earnings per share target, or EPS, which is earnings per share target. Earnings per share target. Next, another subheading, vesting period. We are trying to define those terms. Vesting period as a subheading now. Vesting period. Vesting period. Say this. This is the period during which, vesting period, this is the period during which all the specified, this is the period during which all the specified vesting conditions, this is the period during which all the specified vesting conditions satisfied. This is the period during which all the specified vesting conditions are satisfied. E.g., the number of years, e.g., the number of years an employee, e.g., the number of years an employee must stay in service, e.g., the number of years an employee must stay in service, e.g., the number of years an employee must stay in service. Another subheading, vesting date. Vesting date. Subheading, vesting date. This is the date. This is the date on which the employees become, this is the date on which the employees become entitled to receive. This is the date on which the employees become entitled to receive the cash or the equity shares. This is the date the employees become entitled to receive the cash or equity shares under the agreement. Under the agreement. Under the agreement. Good. So that brings me to the end of that session. So what we shall do next time, now is to do past paper questions. We have discussed the topic. Now we shall do past paper questions. Okay? Just as a reminder, for those who have joined us, just as a reminder, I am just reminding you now what I talked about at the beginning. Please subscribe to our YouTube channel. Please subscribe to our YouTube channel. If you have not subscribed, just click that subscription button so that you'll be able to be notified of future videos as we keep posting them in the YouTube for promotion. Okay? So please subscribe. Click the subscription and the notification. Then I've said, those who have not joined our normal online classes and they would want to join our online classes, either for advanced financial reporting, and for advanced financial reporting, I told you we have either early morning classes or evening classes. Okay? Or I said, some of you are friends who are doing financial reporting of the intermediate. Some of you, I said, have friends who are doing financial accounting of the foundation level or the ATD level, by the way, also. Then I said, for any interested in any of this, can call me on this number, which we said is 0722 65 8875. Call me on that number. Currently, we are charging 4,000 shillings for the online classes. I also told you, listen, of course, we accept payments in installments. Then I also told you, listen, that if you are not able to attend a live class, then you can buy what we call pre-recorded videos. You can buy what we call pre-recorded videos. Good. Sawa sawa. So I think I've reminded you everything that I wanted to remind you, which I did at the beginning. So you can also buy pre-recorded videos for any of those three subjects. So, but please, if you have not subscribed, please subscribe. Okay. Now, listen. This is to everybody now. If you feel you have liked the subject to the class today, like the class or you like the video, you can also click on the like button. If you feel you have liked the class today, like that button. Okay? Good. Otherwise, thanks a lot. See you next time when we shall now do the past paper questions. For the new guys, decide. I hope you will join us by calling that number 0722 658875. Good. Otherwise, see you next time. Bye for now. Bye, everyone. Bye for now. Okay. Bye for now.